Hello and welcome. My name is Joe O'Mara. I am the Head of Aviation Finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined today by Firoz Tarapore, who is the CEO of DAE. Firoz, thanks again for joining us for our Leaders Report 2022. I should say that we're recording this 9 days before Christmas. Firoz, before we get into the meat of the questions, I'd say most of our watchers will know, but would you tell us a little bit about DAE?
Well, Joe, thank you again for inviting us. We're delighted to be part of this annual session that we have. So DAE, for those of you who don't know us, we do two things, aircraft leasing and airframe MRO in our region. And aircraft leasing is by far the larger, I should say, of our two businesses. About 90% revenue. And there we have a fleet of owned, managed, and mandated to manage assets of about 425 aircraft. And on the MRO side, we are the leading airframe MRO in the region. We service clients in Europe, Africa, here, and India through our one very large location in Amman, Jordan. And that's kind of our story.
Great, thanks, Firoz. And as we look, maybe we might start off with focusing on the leasing business and really your customers, right? Very interested to how customer performance has evolved for you over the course of this year.
So 2021 has been obviously better than 2020 from a financial performance standpoint. Because, obviously things are a little bit better regardless of the metric that you look at in 2021 relative to 2020. They are still nowhere near where we need to be to reach our franchise full potential, and that full potential is defined as the numbers that we kind of recorded on a regular basis pre-pandemic, if you will. So we like the trend of the recovery, but not the pace of the recovery. I think that the various levels of ongoing uncertainty, including new variants or new requirements, or this massively uneven level of vaccinations around the world, is still something that is going to impede our business going forward. And as we all know, the narrow body side of things has done substantially better than the wide body side of things, because for the wide body aircraft to be flying at their pre-pandemic levels, national harmonization of policy and rules, et cetera, is a much more strenuous exercise than just flying narrow bodies in domestic markets. So we are very hopeful that will continue, although I have to say that this latest variant is now beginning to show that the trajectory that we expected post November 4 or November 5, when the US said international borders are open for vaccinated travelers, that trajectory is now going to be dented. And we just have to kind of see if the mild nature of this new variant allows people to feel more comfortable to go about their lives, albeit with more caution, but to go about their lives as it relates to utilizing air travel to complete that portion of their life, whether it's business or leisure or whatever. I think it's fair to say that still remains to be seen, with a keen eye on how this variant is doing in certain geographies that it seems to be multiplying every couple of days now. So.
And to the point you mentioned there around that, probably diversification of recovery around different geographies, and that's probably linked to vaccine rollout. It's linked to probably government protocols around restrictions. But when you think around opportunities and markets where you're looking to expand market share or interact with new customers, are you going at that with a geographic slant on it, or is it just come back to the fundamentals around the quality of the airline?
For us, it's the fundamentals. So for example, there might be some short-term opportunities in large domestic markets. So as you know, we did a very large deal with the US airline last year. because we had confidence in their ability to work through the market environment, and there was some near-term floor because of the large domestic operations. But I mean, when we look at a longer-term picture, we clearly see that everything that made aviation an attractive investment proposition, all of those fundamentals are still in place, whether it's population growth, demographics, disposable income, et cetera, et cetera. And so the only open question becomes, what does this pandemic really mean in terms of the severity and in terms of the duration of its impact? Because when we look past it, air travel remains a fundamental kind of growth proposition, if you will. So we are investing using that thesis, and we are investing with an eye towards protecting short-term uncertainties, but long-term, fairly certain outlooks, whether it's narrow body, wide body. So that's how we're thinking about it. We're not kind of thinking about it from a specific, let's expand here or expand there.
And on the more broader topic of leasing, we've seen the pandemic result in a shift of an increase in the proportion of leased aircraft. And we kind of knew last year was maybe 55% of Airbus deliveries. Anecdotally, that number seems higher again this year. Do you think that movement, that increase in popularity of the leasing channel is here to stay and sustainable? And as an add-on to that, do you think there's a ceiling over what that percentage of leased aircraft could get to?
Well, firstly, you know, it's kind of undeniable that leasing makes available to operators a choice that allows them to be quite free with the models that they want to bring to market, meaning business models that they want to bring to market, wherever they are. And so I think from that standpoint, it is always an enabler that will be around and will continue to become kind of more and more significant. The pandemic clearly was a period in which airlines got hit, some with 100% loss of revenue, and therefore conserving capital for them was a massive thing. And as they, one of the levers that they pulled to conserve capital was to rely more on other people's capital like ours. You know, one should expect that the leasing percentage should go up. And that is something that will get addressed depending upon how quickly the industry goes back to profitability. But if you look at the last 3 or 4 years that ended with 2019, it was a record period of profitability for airlines. And when you look at the rate at which they've accumulated capital, if we see such a period again in the short term as the pandemic ebbs, now we're not saying when that'll happen, whether it's 22 or 23, but when that happens and if profitability comes back, we fully expect that airlines will use that self-generated capital to kind of put more of that work to support their long-term growth requirements, if you will. So we should see that number kind of toned down a little bit. Over time, I think that just as we and other people rely on diverse sources of everything that we need to be successful, airlines will rely on diverse sources to make their business model successful as well. So leasing will continue to have a significant floor. I'm not sure that there is a natural ceiling, but I would expect that just as intellectually, if you believe in a floor, you must believe in a ceiling as well. But that portion in the middle, with that constantly expanding pie, once we go past this period, will keep the overall profit pool healthy and growing for lessors.
And that element then in looking at the wider leasing market, how competitive have you found it from a pricing perspective? And have you seen material shifts pre and post COVID around lease rate factors and the level of competition that's out there in looking to win that business?
Yeah, so I think that when you look at lease rate factors or other kind of metrics of origination or profitable origination, we are subject to the same basic economic elements of supply and demand as any other industry. So if we have significant supply of both debt and equity come into our markets, we will see that. And post pandemic, we saw incredible appetite from different types of players. And those players continue to drive competitive outcomes in the kind of SLB market. So one component of our market. There are other components of the market where relationships matter in a different way, balance sheets matter in a different way. And there we don't see that much competitive tension going on. And the returns actually are quite healthy. So I think there is one pocket in our business, which is this new SLBs for stronger carriers, where everyone wants to get that business, and therefore prices go kind of where they shouldn't go to create economic returns for the deployers of capital. But nonetheless, that is there. That's not going to go away soon, because the fundamentals of our business remain kind of quite aggressive. And every time there's a new person comes in, they look at the fundamentals in a different way, justify a lower return initially, and each person has their own. So, look, from our standpoint, the starry-eyed capital that came into this industry in the mid-2010s, that sheen is gone. Some of them are on their way out, and frankly, all of them will be on their way out soon. But replacing that is a very hard-nosed capital, which is coming from US private equity firms, who effectively look at an investment thesis that say, well, if we pivot around base value and buy it at minus 10% and sell it up 10%, aren't we geniuses? That capital is kind of coming into this market and affecting us as well. But sooner or later, that will peter out as well. So we will see whether this is a sustainable a pricing phenomena or something that is a reflection of the volatility that we're seeing in the marketplace.
Yeah, that's interesting. And one of the points around that, as you say, that investor outlook, and your thoughts are very interesting around the coming and departing capital. And obviously, if you assume we will get over the crisis that we're in, and that will happen, you're still going to have billions that need to be funded. Can I pick you a bit more on the trends you've seen on capital coming and going, and who you think will be funding all those capital requirements over the next kind of period of time? Is it those players you chatted about? Is it US private equity, which has always maintained an interest but has seen to spike over the last couple of years? Or are there other kind of pillars of capital that you think are going to become very important in aviation finance?
So, one of the OEMs, when they do their funding update around the world, they have a very interesting chart of each of the sources of funding that they have seen to fund their deliveries. And they do a multi-year thing. So 10-ish years kind of traffic light system. And it's very telling that the pools of capital kind of go up and down, and traditionally export finance. Export credit has played a bigger role, but not recently. But when I look at the total picture, I would make an operating assumption here that when you look at the capital that the lessors have deployed into this space, when you look at the funding / capital that is available from the core aviation banking segment, so not the fair weather bankers who come in and leave, but the core aviation banks that have been around for a while, and who know how to deal with the cyclical element of our business, and the capital generation from airline profitability, that over time, it's by and large matched up to support the overall growth of the aviation, commercial aviation industry, if you will. And supplementing that from time to time is opportunistic capital. And every industry must have that, otherwise you lose your competitive edge. Now, in our case, I think oftentimes, or in the last decade, we have seen an oversupply. And that oversupply drives pricing. And what that means is that the basic amount of capital that we need, both from an equity and debt standpoint, is demonstrably there, and I think will be there if you look at the next 20 years forecast from the OEMs about how much we end up financing. The good part about the last 10 years is that since the global financial crisis in 2009, all of the work that all of us have done to highlight the investment theses of this asset class, which was not a separate asset class back then, it was more like an esoteric, here comes something that we need to understand. That is now a permanently embedded feature. And that asset class allows a kind of a multiplier effect to come in place when it comes to attracting kind of more traditional financial classes. So I think that that's not going away. And when you combine that with the expertise that's in the leasing community to manage that capital, the adequacy of that should be more than enough to support the next 20 years or more growth that we expect to see in commercial airlines.
It probably feeds into, as you say, that maturity and sophistication of the aviation finance sector has fed into what we've seen IG lessors been able to raise on the unsecured markets. And obviously a space you would know very well. Your thoughts on the ability or your expectation for the large IG rated lessors to continue to be able to tap that unsecured market? Is that something now you think, look, the dam has been broken, there's belief and confidence in the model, particularly when we've seen this type of stress, that it will persist? Interest rates will likely rise over the next kind of 12, 18 months, but that lessors will be able to raise at very competitive rates wherever that market sits.
I think one of the things that the pandemic highlighted is the diversity of the lessor business model and the resiliency of the lessor business model. In that, for those of us, and there's quite a few of us who believe in proper asset diversification. So for example, just using our numbers, our own fleet is distributed amongst operators in a way that we have no more than 3 aircraft on average per airline. That regardless of what happens to 1 airline, 2 airlines, 3 airlines, 4, 5 airlines, that our business model has that element of diversification built into it. And I would submit that most leasing company models have that as well, with obvious exceptions. If you break that rule and you concentrate, then of course you get into trouble. But that resiliency, and particularly so in investment grade rated companies, I think has allowed the market to differentiate between providing capital at competitive spreads to that segment of the industry versus other segments of the industry, if you will. So long as that resiliency is demonstrated quarter in, quarter out in our financials, which means that the lessors have maintained their underlying discipline, then I think that access to that pool of capital will continue to be there at very reasonable spreads. I mean, the market, of course, determines what that is, but the spikes around expected credit losses for us will be quite minimal, given how we as a group have managed to navigate our capital to this particular part of the industry, if you will.
And when you look at that ability, the likes of yourselves and others, to raise that capital markets unsecured debt, if you're not able to tap that market, is that going to be a fundamental challenge for growth for you?
I would say that the answer to that is no for all of us. Firstly, because part of the rating process is a vetting of what we can do if that access goes away. So principally, that point is stress tested in allowing any of us to be rated at that level. And because all of us have been doing this for a while and understand the vagaries of liquidity not being available to a business model in a cyclical industry, our preparation levels are at at all-time, I would say, highs because of the way we prepared for such a thing happening. So if you remember, going into the pandemic in early 2020, nobody really knew that the capital markets would perform in the way they did throughout the pandemic. And that would have been a great test to find out if all of our funding plans and the contingency plans that we had in place would work. But we, for example, maintain liquidity coverage that is north of 200%. I think others do as well. And that means that anything for the next 12 months, we have more than 2 times coverage of that. And when you have that kind of protection, I think that you're able to sort out other things. And throughout the course of it all, we have maintained access to just about every source of capital out there. So whether it's unsecured, where we have 70%, whether it's secured or whether it's export credit or whether it's the unique liquidity that we have because of our presence in this region, that has always been there and we've never lost that. So we always keep on testing it despite our commitment to do more unsecured. So I think that even if we had lost access to the US capital markets, that we and others, I think, would have done just fine, because that stress test is built into why we're IG in the first place.
And on another kind of leg to the debt piece and capital markets is clearly the ABS market. It's a space you played in pre-COVID and one you've now returned to post-COVID. Have you been surprised at how quickly that market has come back, and where do you see it progressing in the near term?
I would say that actually that market has not come back fast enough. And if you look at that market, of course, it's not a homogeneous market. And so most people, when they sell securities, they sell an A, B, C, and then the equity note. And I would say that the recovery has been quite as predicted. So for example, A's, which are the strongest from a collateral perspective, they came back very quickly. B's came back right after that. C's came back. But I would say that the amount of time that it has taken for the C's to recover, for example, given how robust the lessor model has been, I would say probably longer than required. And the E-note, in my opinion, should have been back to fully functional at the moment. I don't think it's there just yet. So, I would say that the asset-backed market, where very sophisticated players understand and stress a very complicated pool of cash flows, by the definition of their sophistication, they should have been the first ones or amongst the first ones to kind of lead the recovery. And when I say lead the recovery, capture disproportionate amount of profitability, because you extract your pound of flesh from the issuers as you go along, and that performs quite well. And I'm surprised that hasn't happened. I would have expected that to happen a lot sooner than it really has unfolded.
And would you see that tradable E-note, as you say, that E-note market? Totally agree with you. We've seen that the deals we've seen come back have been predominantly debt focused and maybe clubby equity with one or two partners within it. Do you foresee over the course of 22 that tradable E-note structure, that appetite for ABS E-note comes back in a real way?
Well, my expectation, if you had asked me this question 3 months ago, so in September, would have been that we would have seen one E-note transaction in 2021. Now, with 14 days left to go, or 15 days left to go, I think that outlook is not going to come to pass. But my expectation is that given everything that we are seeing, that it's very reasonable that more than one E-note transaction should price in the first quarter of 2022.
Yeah, I would echo, I think, that belief. On the wider space within leasing, on the kind of M&A and consolidation point, and obviously you haven't been afraid of significant inorganic growth in the past. You look at what's happened across the space, probably at the start of 21, and maybe the rumored deals that we're seeing that'll probably be Q1 or Q2 next year. What we've seen a diversification or a breakdown in concentration of the leasing market. You go back 10 or 15 years ago, the top 3 players probably had 60, 70% of the market, and that had flipped where, the top three probably had 30% of the market. Do you think we're in for a period where the big players are going to continue to get bigger and that concentration element will dissipate a little bit over the coming years?
I think that scale continues to be defined upward. It has been every year for the last 20 years. And I think that there is still kind of room to go. Only because now, to manage the complex and the more pronounced risks that we see and were highlighted for us in this last 21 months, I think there is no such thing as too much capital. And to the extent that we can use that to then further provide the stability that our clients need from their counterparties, I think that will become a more important thing going forward, particularly as these counterparties now tend to refleet and regrow their business. So I think one of the things that was highlighted very clearly during this pandemic is that if you were an operator and you decided to do your SLB with a lessor who then otherwise couldn't figure out how to fund themselves or was not able to or whatever, that reliability actually does matter. And from that standpoint, size is of consequence. And I would say that the top 10 are probably going to get bigger as a group because other than the one or two right at the beginning, there is still scale headroom that is quite material relative to the current size of, let's say, number 3 to number 10.
No, that's interesting thoughts. And as obviously that scale increases and the percentage of leased aircraft increase, the direct interaction naturally you would expect between large scale lessors and OEMs will also increase in theory. You can correct me if you think I'm wrong on that. How do you, or what impact do you think the pandemic and that shift in the importance of the leasing channel will have on the relationships between lessors and OEMs? And do you think, again, looking out, we're going to see more lessors go down the order book route?
So I think that is one element of our industry that defies logic, meaning lessors are effectively distributing metal on behalf of OEM and attaching their capital to provide a package to our clients. And unfortunately, with no defined rules, so for example, if you look at more conventional industries like automobiles or heavy machinery or whatever, there are distributors and there are territories and there are agreed upon price levels relative to volume commitments, et cetera, that allow the intermediary to deploy their capital with a high degree of confidence. In our business, it's not that way. And I think this is one of the OEM behavior attributes that I think will continue to be a challenge for all of us to consider. And this is no surprise. I think everybody knows it. OEM knows this as well. So that if you've appointed 17 lessors on your program and just basically given them product whenever it suited your skyline the best, without any consideration to qualifications, territory, customer demand, et cetera, that one element is still a negative element, and I think it will still continue to haunt that specter of our business that would allow capital to kind of flow more freely. Despite kind of OEMs saying that they acknowledge the issue and want to deal with the issue, we don't see anything happening. So I think that relationship will continue to be a evolving relationship where the supply-demand flavor of the day will drive whether the discussion is a nice one or not nice one.
And shifting gears a little bit and looking at what will be the existential risk and challenge that we will face in broader community and then clearly in aviation is around climate change and ESG. I think we know the targets that are there. We know the kind of building blocks that people expect will help us get there, whether that's SAF, whether that's technological developments, the benefits that are already brought by new tech aircraft that you would expect to continue. Can I ask you specifically, though, in thinking of aviation finance, in that this is clearly a huge issue and challenge, but is it feeding through now either on your equity investor conversations or having impact on basis points and what you can raise? Is it having any impact now? And if not, when do you foresee that coming through?
Yeah. So one of the things that we see very clearly is a rapid shift in our investor base, and this is mostly the fixed income investor base, a rapid shift around how they need to deal with ESG. So we have gone from this being a kind of issue that 25% of the investors would talk about or ask us about, to being an issue where 100% of the conversations now include a component of that, and a very large and growing percentage of that is now supported by dedicated ESG analytics within each of those investor houses. And the bigger the house, the more resource and the more focus. So we're seeing anywhere from discussions that focus with, what does your external rating look like, to here's our extensive range of internal criteria that we look at. How do you stack up on all of that? So I think at this point, the greenium, as people call it, is not perceptible, meaning you can't differentiate that from a healthy kind of oversubscription position in a book. It's impossible to tell whether it was one or the other. But I think what is absolutely unequivocal is that our investors care about this in a way that, unless we pay attention to it in a meaningful way, not just a lip service way, that this will become a pass-fail issue. It won't become a, do we save 4 basis points or 7 basis points or whatever. And I think it is, everybody recognizes, to everybody's credit, meaning investors and issuers, that it is a continuum issue. It is not something that anybody can solve overnight. And I think as long as we see the right steps being taken to move us to the appropriate side of that continuum, then I think the markets will function well, and pricing will sort of take care of itself as people make their relative differences felt in the marketplace. And everybody will take, at least in the next 5 to 10 years, a different way of how to get there, till there is a clear winner of what it means at the aircraft level for sustainability.
Yeah, no, very interesting points in that. And I agree with you, right? It's clearly coming, and how you tap that appetite or try to make aviation, not have a bad name in those investor spaces and bring through the good things is going to be a challenge, and clearly a conversation topic we're going to come back to a number of times in the near future. Can I ask you in closing, Firoz, as you look out over into 2022 and the extreme challenges we faced over what feels like 10 years, but is really coming up on 2, how optimistic are you, both for the wider aviation recovery and just your own ability within DAE to prosper in this fractured market?
That's an easy one for us because, as I said before, I think we fundamentally believe that commercial aviation is an integral part of kind of life in general. As you look at the overall trends for who we are, how we want to live our life, and how we go about doing that, yes, there are absolute imperatives around climate change, around environmental issues, et cetera, et cetera. But within that, because the developments are happening in parallel, the requirement for and the opportunity for commercial aviation to continue to have the space that it does is at least unquestionable in our mind. So we're investing for the long term. 2022 for us now comes right down to whether or not the short-term environment will come back, or some event that we don't know of today, a new, kind of deadly variant or deadly version of it comes around. So if recovery is as we think it is, then 2022 simply becomes a matter of making sure that our clients can do the business that they need to do to be able to repay us for the deferrals and amendments that we've given them. It's as tactical as that. And to some extent, we all kind of watch and make sure that that happens. Overall, we remain extremely bullish about what the next 10 or more years will bring.
Firoz, on that very optimistic note, I'd like to thank you as always for your time and excellent insights, and wish you and DAE a very successful 2022. Thanks again.
Joe, thank you, and wish you the same.